All right, today we're going to break down a crypto trading strategy that makes a pretty wild claim, hitting 125 times leverage with supposedly zero risk to your initial capital. So we're going to dig into the source material and walk through exactly how this is meant to work, step by step. Okay, let's start with the number that catches everyone's eye, 125x. That is a massive amount of leverage. It's the kind of multiplier that can turn a tiny move in the market into a huge gain, or, as is usually the case, it can wipe you out completely in the blink of an eye. Next up, the amount of money put on the line in one of the live examples, just $16. A surprisingly small amount, right? But as you'll see, using a tiny stake like this is a huge part of the whole trick, really. And then there's this number, 800 bucks. That's the profit they claim you can make from that tiny little $16 stake. I mean, that looks almost impossible, right? So how do you get from $16 to $800? Let's dive in and see how it's supposed to work. Okay, so first up, the tempting promise. We've seen the flashy numbers, but what's the actual promise that's being made here? What's the core claim that makes this all seem possible? So here's the claim in a nutshell. There's a way to use max leverage, 125x, in a trade, but here's the catch. You only crank up that leverage after you've supposedly made the trade risk-free. That's the key. And that right there should set off alarm bells for anyone who's ever traded. I mean, leverage is risk, right? They go hand in hand. So how could this possibly be true?
Well, to be fair, the creator of the video actually points this out himself. He says, look, you're not just jumping in with 125x leverage right from the get-go. That would be insane. Instead, you only flip that switch to 125x at a very specific point after the trade is, safe.
So, okay, how do you even start something like this? That brings us to the starting point, the first trade. And you might be surprised to see that it starts off looking pretty normal, actually.
So you don't start with a crazy gamble. You start with a totally standard, much lower leverage trade, something like 10x. And the most important piece of this whole puzzle, right at the beginning, is setting a solid stop loss. That stop loss, that is the only money you can actually lose. That's your real defined risk.
Okay, so check out this real example from the source. You see a position size of almost $5,000, opened with just under 500 bucks of margin. But, and this is the part you got to pay attention to, the actual risk, the most they can possibly lose if things go south, is just $28, all thanks to that tight stop loss.
All right, now we get to the turning point. This is the move that makes the whole thing tick. This is where they claim to eliminate all the risk, and it sets up, well, everything else. And the move itself is actually super simple. You just wait for the trade to go into profit, even by just a little bit. The second it's in the green, boom, you move your stop loss right up to the exact price you got in at. And what you've just done is create what's called a break-even stop loss. So think about what that means. Your worst-case scenario is no longer losing that 28 bucks. The absolute worst thing that can happen now is the price comes back, hits your stop, and the trade closes out at zero. You get your money back minus maybe a few cents in fees. Your initial risk? It's gone. And that brings us to the trick. Because now that your downside is protected, you can do some really wild stuff with the structure of the trade. So here's the maneuver step by step. 1. Get the trade into profit. 2. Lock it in with that break-even stop. 3, and this is the crazy part, you jack up the leverage all the way to the max, 125x. And 4, you pull your original margin, pretty much all of it, right out of the trade. Let's just look at this transformation side by side. The key thing to get here is that the position size, that almost $5,000 position, it doesn't change. But look at everything else. The leverage goes from 10x to 125x. The margin holding that position open drops from almost 500 bucks down to just 30. And the risk to your own capital? Zero, because you've got that break-even stop in place. So this puts you in a really weird, kind of powerful position. You're still controlling this big, highly leveraged position that could make you a ton of money, but your original stake, it's not even in the trade anymore. It's back in your wallet, totally safe. But wait, it doesn't even stop there. According to the source, once you have this, quote, risk-free position set up, you can use it as a launch pad to go even bigger. So now you can start feeding tiny amounts of money back into the position. And because you're at 125x leverage, adding something like 10 bucks of margin increases your total position size by like $1,200. It's insane. So if the trend keeps going your way, your potential profits just start to snowball. And at this stage, the only thing you're actually risking is the profit that's already on the table, your unrealized profit, not your original cash. And the creator of the video says this is how you can start to trade like a big fish, controlling these huge positions without actually having a huge account. It's all about turning, say, $7 into a position that's worth thousands.
And, they show a live example of this whole thing playing out. They claim they locked in over $500 in profit from a trade that at the end of the day was only being held open with $7 of margin. I mean, that's less than lunch.
Okay, so what are we supposed to take away from all this? We've basically walked through a clever system of mechanical steps, right? You get a trade in the green, you protect your entry, and then you crank up the leverage to free up capital and amplify your potential winnings. But this all boils down to one really important question. Is this a brilliant strategy for calculated risk, or is it just a fancy way to gamble? Because think about it. Yeah, your initial stake might be safe, but the whole thing depends on everything going perfectly. You have to hope there are no platform glitches, no insane price spikes that just blow right past your stop loss. And you have to deal with this psychological pressure of watching these huge potential profits that could literally disappear in a split second. That right there is the real risk that isn't on the balance sheet.